Thank you. Thank you for this opportunity. I am Anil Dodani at Scotia Bank. I am actually a home financing advisor with Scotia Bank. I do residential mortgages. I've been doing this from the last 9 years. I've done enough mortgages that I have no count how many I've done of every category. Now, my partner, GE, Annie Carpentier, she will also join and give us some insights about the product later on. My focus here today is to give you an idea how to capture the investor market and how to educate them how they can make more money. My expertise are more towards residential side of a mortgage, more of a self-employed and investment category. Not that I don't know any other segment of it, but that's my key expertise. Few people have been asking that rates have gone up or so. Now, yes, rate has gone up, but depend on the certain circumstances, what client is putting, and we can talk on case-by-case basis. But rate will keep on going up, moving forward. It's not going to go down. We have still time to capture that market with the maximum utilization of funds. Now, tell me one thing. We all are here for a cause. So what that cause is? Absolutely. You're not here for charity. Who is? Anybody? Anybody's here for charity? No? So we are all here to make money. And how to make money? That's the key part. In this market, anyone can share in 2013, what change have you noticed in people's mind? Statistics shows this year, the people who have money, who are first and second time buyers, they are focusing more on investment properties. For the people who cannot afford, who want to stay in the rental market, the people who are going to rent for a longer time, those are the segments the people who has money is focusing towards. They are deviating their investment. So now is a common thinking that bank account give you 1% interest rate approximately if you look at it. That's the common thinking of the people, and GIC give like 2%, bond 3%, mutual funds anywhere from 6 to 8%. If someone is really good in stocks, he will make 9% interest in a year. If not, he can have a dip of 10% depending on which stocks he's buying. But real estate is a stable 7 to 8% return. That's what the people think. But in reality, at the end of my presentation, you will see that in real estate, an investor can make over 200% in his pocket in a year. So that's the change we have noticed, that in 2013, the people who has money, they want to invest in real estate to capture the rental market. The people who has no capacity to buy today and they are going to rent, that's the market they are focusing. They want to maximize their return on that. Now in real estate, everybody knows location are the key factor. Maximize the rental potential. That's the investor think at, right? And how to capture what people think based on the investment they want to do in real estate, what people think. Like renovation, that's the first thing they come up, what amount of money we're gonna invest in that investment property. Well, new condos are there. That's the solution, new condos or houses which are 5 or 10 years old, less renovation is required. Even if a renovation is needed, we're going to talk about that we have a product where client can maximize their return, and we as a bank will fund them to do the renovation. Now, every investor thinks about cash flow. Now, what cash flow we are talking about? Now, let's say, for example, $250,000 is a condo price. If client want to invest in, based on investment property, every person has to do nowadays 20% down, which is $50,000. So on that $50,000 on $200,000 mortgage, at close to 3% interest rate and 30-year amortization, the monthly payment will be $1,400. Now on that $1,400, that's the rent coming in. What are the operating costs of that condo? Close to $841 will be the mortgage payment, which principal and interest, and property tax, you can say $180. Maybe the condo fee is $200. Let's say condo strata townhouses. Or insurance, it's up to him if you want to take it, $14. So total ownership cost, we're talking about $1,235. Minus the rental cost, he will have $165 every month cash coming in. At the end of the year, $1,980, that's the cash kicks in his pocket every single year, apart from the appreciation. Now, average, if we say real estate is appreciating 4% every year, am I right? Anyone? Average? Conservatively, right? So 4% appreciation is there. So every single year, it's a $250,000 investment, $10,000 he is pocketing it. He's actually accumulating it in his equity. Now, sorry. From that $841 monthly mortgage payment, $494 is going into interest and $344 is going into capital. So that capital is his real profit. It's a non-taxable profit for the client. Because whenever he sells it, he will only pay taxes on capital gain, but not on the principal portion of the mortgage where what it has been paid by rental. So that's his real profit. So at the end of the year, he will accumulate $4,181 in capital. Altogether, if you look at it, every year he will make 32% on his $50,000 investment, which he did as a down payment. Let's say in a second scenario, client is a homeowner already and he has an equity. If he cash out his equity for $250,000 property, $50,000, he cash out his equity, the additional amount of equity which he's going to take out is $210 for $50,000 on 30-year amortization. Now, if we add $210 every single month, there is a negative cash flow of $45, which again, any negative cash flow for that XYZ investor is a write-off in their taxes at the end of the year. So it's actually going to offset at the end of the year. It's actually a scenario the client do not have $50,000 cash sitting in his account. He is taking equity out, his existing equity out, $50,000 to invest in an investment property. So he's not using his hard-earned savings. He's using his equity to make another equity. In that scenario, $45 a month will be a deficit. So at the end of the year, for $540. Now, if you look at it, the interest and principal portion of $50,000 and the $200,000, which is absolutely the mortgage, the interest and principal of $50,000 is $124 interest, $86 will be the capital. So at the end of the year, he will make $5,229 into a capital. What is it? $10,000 is an appreciation, as we took 4% appreciation, a normal appreciation of a property. Deficit of $540 if he's using $50,000 equity as a down payment for the investment property. And same, a return on built on equity is $5,229, which he is building up by paying the mortgage. So at the end of the year, in a year, what percentage of return he gets? He only paid legal fees from his own pocket, which we cannot help. Everyone has to pay the legal fee. So on that, he is making 419% profit every single year by not using his own hard-earned savings. Yeah. So now if you look at it, if that property is kept for 5 years, so how person get rich? If a property is kept for 5 years, including his principal residence, I'm not even including the principal residence, only that investment property alone. If a person has a one investment property, in 5 years, his total net worth will be close to $619,000 total. And if a person purchases 5 investment properties, his total net worth, by cutting off all the operating cost, will be $1.7 million. So, sorry, in 10 years. So in 10 years, you'll be richer than you think by using your money or using your equity in a wiser manner. So it all depends upon how you think.
The only things that I wanted to talk to you about are actually, well, you know that it takes 20% cash down if you want to invest in properties, in rental properties, right? So that's not my area of expertise, because I'm a mortgage insurance company. I'm actually insuring deals where your clients would be putting less than 20% cash down, right? So investment properties, I'll let Anil manage those transactions with you, because obviously, because your clients are putting 20 or 30% cash down, they would not require mortgage insurance, mortgage default insurance, right? However, there are a few advantages that I wanted to highlight with you based on the documentation that I've provided you with. You know that your clients that are interested in buying a secondary home or a vacation property, right? You may have some of your clients that are doing well financially. They've invested with Anil with the 20% cash down on rental properties. The only thing is that they would like to be able to use some of the equity that they have to invest in an owner-occupied secondary home or vacation property. So in both cases, they would be able to go up to 5% cash down, or at least 5% cash down for a property that's called a type A property, which is pretty much anything that has to do with the regular type of properties that you would finance on a regular basis. So for example, I live in Niagara, and I want to buy a condo because I work downtown. So I want to use the condo 4 or 5 days a week because I work downtown, and I want to go back to my primary residence in Niagara. I could buy the condo in downtown Toronto with a minimum of 5% cash down and still consider it as a primary residence, only it will be a secondary home, right? So this just goes without saying that this also applies to your clients, right? So it's interesting for you to know that this vacation, or not the vacation B, but the type A property, which is the exact same thing as any regular product, only it's a secondary home, there would be a regular premium that would apply, so 2.75%, given that you have sufficient income to be able to service the debt. If some of your clients would like to buy a secondary home that is also considered as a vacation property, right? So if I'm buying a cottage is located on an island, so the only way that I can access my cottage would be by boat. We can also do those properties. Minimum cash down would be 10%. The premium is a little bit different because obviously there's a greater risk when it comes to type B properties, but this is also something that Anil can finance for you, right? So type A properties, type B properties, if you want all the full specs of information about those type A and what is considered a type A and what is considered a type B, I actually have the link here on my iPad. I can show it to you on the website, but again, on the documents that I've provided you with, you have the genworth.ca website. Please visit the products within the realtor section. There's a product section. You just scroll down to vacation or secondary homes, and you'll find all what pertains to the criteria that your client will need to know before they're actually buying that vacation property or secondary home. So that's one of the first options that your clients would have. I also wanted to remind you about the Purchase Plus Improvements program. That's really interesting. And I know that we've talked about it a little bit, like I think it's a few months ago. What I wanted to specify as well, Anil, and Scotia has the ability to go with major renovations. Right? So if one of your clients wants to buy a house that's located in a perfect location, but they just want to do major renovations to the property because they want to redo the basement, they want to redo the kitchens, and they want to have new bathrooms, that's possible for them, considering that they would be exceeding the 20% of the property price, or $40,000. They can exceed that amount, and they can even benefit from multiple disbursements while they are having the renovations done. Okay. Why am I talking about this? It's because Anil has the ability to do the multiple disbursements as well for major renovations. That's a major selling feature for you as well, right? Because it will allow you to have those discussions with your client. They are pre-qualified, and knowing about the fact that they can have Purchase Plus Improvements program, it will allow your client to negotiate with the sellers the ability to go back to the property with the contractors and have some quotes done, and even quotes for major renovations that would be done. Yes, sir?
The major renovation you said, is it 40,000, above 40,000, or the percentage of the property?
It actually...
How do you know what is a major renovation, above which level?
Okay. Very good question. Actually, the line is as soon as you hit either 20% of the purchase price or $40,000, whichever comes first, this is considered to be major renovations. So in these cases, we'll ask for the quotes because we want to know what kind of work is being done, who's doing the work, what materials being used as well to have the work done, because this will impact the as complete value as well, right? We'll order the appraisal. We will pay for the appraisal on behalf of your client. So that's not any extra money that your client will have to dish out. It's our own responsibility to issue an appraisal report to determine the as-is value, so your client knows that he's paying the right market value for the house as is, and based on the quotes that he will present, he'll know how much will the house be worth once the renovations will be completed. So that's a great value added for you as well, because you have the ability to have the discussion right from the get-go with your customers while they're in the process of looking for a house. So that's just another one of the options that are available to your clients as well. And I just wanted to focus on those two things because time is limited. And again, I mean, you know, we'll probably see each other very soon as well. But please take a look at the documentation that I've provided you with. At the back, you see that we've outlined a few interesting things that we've activated from our website for realtors. So on our website, the genworth.ca website, if you go to the realtors section, you'll be able to access mymarketingsource.ca, and mymarketingsource.ca will allow you to issue all the product overviews that you'd like to do advertisement on, such as the Purchase Plus Improvements program or the New to Canada product or any kind of other products like this. So please visit the website whenever you have a moment. And I also wanted to talk to you about one of the advantages that you have by having that your clients would have by being insured by Genworth. It's called the Home Buyers Privilege Program. So your clients will be able to save some money when they are insured by Genworth. They'll be able to save some money with movers. So AMJ Campbell Van Lines is one of the suppliers that we have an agreement with. Dell Canada, Bell. We have also Target Vacations that is part of the agreement that we have. So we're allowing your customer to save money with all those suppliers just because your clients chose to do business with Genworth, right? So it's just important for you to know all these things. You also have the ability to create those documents on your own with your own photo, logo, and all contact information so that you can promote that Home Buyers Privilege program as well. So again, mortgage insurance, it's a means to an end for most of the clients, right? Because they don't have a lot of choice, right? If they're putting less than 20% cash down, they have to insure the mortgage. They have to pay the premium, regardless of which mortgage insurance company it is. But if you can forward or refer them to the mortgage insurance company that will help them save money and help them get some special rebates, then your client will be very appreciative of that.